Great, thanks Megan. Hello everybody. Now I know what it feels like to be a professor where no one will sit right in front of you. Just a few quick remarks. First of all, everyone welcome. Thank you for coming out this morning. I know a lot of you are local, but we also have a lot of our friends from a bit farther away who manage some money for us, so we appreciate y'all coming in town too. Today we're just going to have a conversation about how we invest, steward, and grow the charitable resources entrusted to our community. As a community foundation, we have a big responsibility. We manage assets in a way that not only generates strong returns, but importantly strengthens the Jewish and broader community for generations to come. Like I like to say, our job is being the permanent capital of the community, and it's a big job. As of today, our foundation manages over $380 million worth of assets. This represents the generosity, vision, and commitment of our fund holders, custodial agencies, and donors. These funds fuel scholarships, endowments, and nonprofit initiatives that make an impact both here on our local community and actually across the world. Investing at this scale is not just about returns. It's about resilience, stability, and ensuring that every dollar entrusted to us is working to fulfill the philanthropic purpose. Today, you're going to hear from investment experts on how we navigate these responsibilities, balancing market opportunities, mission alignment, and long-term sustainability. I want to thank today our investment committee, our custodial partners, our professional advisors, and most importantly, our valued fund holders for your commitment to ensuring that DJCF remains a leader in strategic philanthropy. With that, I'm going to turn it over to another one of our partners, Steve Orr, who heads up our investment committee, to tell you a little bit about how we approach that.
So thank you all for joining us today. You know, managing an investment portfolio for an institution is fundamentally different from your personal portfolios. You know, we expect every dollar in a donor-advised fund to be given away at some point. We just don't know when. So it's a liability in a sense. It's waiting to go out, but we don't know when. And so it's our job to, as a fiduciary, to steward that growth along the way. We also have endowment assets where you think about that horizon, it's really when the sun swallows the planets. So it could be, in our minds, forever. And so again, let's steward that, grow it, have a very long-term horizon, very different from those of us in our personal life that you're looking at the screen or you're looking at the blowhards on CNBC and thinking, oh no, and because that's our job, is to scare you a little bit, and that's not what patient capital does. Patient capital is a steady hand on the throttle that doesn't get scared. So our approach to portfolio management, 3 key principles: long-term growth and stability, risk management diversification, and most importantly for us, mission-aligned investing. Jewish Community Foundation, we recognize we have the power to impact our values, to grow the Jewish experience here in the U.S., continue the Jewish experience, most importantly. There's impact investing involved, Israeli bonds, J-Lens. You're going to hear from our friend Dan Frankenstein on Jewel Ventures that align our returns to grow the foundation with a purpose to grow Jewish values. Now, personal portfolios, your risk tolerance, your horizon, much shorter, but we want to make sure that we know in the future those donor-advised funds can continue to grow and that we have an unlimited horizon because we just don't know when that money's going to leave. So in the last 12 months, we've retooled our investment committee a bit, pretty excited about that. And more importantly, we have retooled our fund offerings to be more responsive. Now, the chair guide, you don't look at that. The chair is just as important as everybody else. But again, we're expanding the investment committee. I've been told a pay raise is in the offing by the board. And so,
we're going to double it.
Okay. And so, again, applications are accepted and operators are standing by. So please show your interest there. Now, Also, we have retooled our pool offerings to simplify and also to allow fund holders to sort of grow your own allocation in a sense. So we're pretty excited about that. So if you want to take a little bit more active role in your fund allocation, you now have the ability to choose from different asset classes. We couldn't do that before. So this has been a tremendous amount of work. Somebody mentioned gray hairs earlier, which wasn't very fair, but that really applies to Jerry because he has worked very hard with Greystone and our accounting people to really retool all this, and we're very excited about the work that he and his team have done. So hats off to Jerry. Finally, we're honored to have an outstanding group of folks here to educate us today. And your worst case, I come back later for Q&A. So let's get started with Marty Dutch from Morgan Stanley. Thank you.
I wanted to start with this slide because this is why we're here. So the mission of the Dallas Jewish Community Foundation, this is a different space. This is important. The work that you're doing here is collective philanthropy. And I want to remind you that you really have a partner that can help you do philanthropy well and knows the community better than anyone else. And this is something that, as philanthropists, you want to lean into. And at the end of this talk, I'm going to challenge you a little bit there, too. So we're really talking about mission-aligned investing. And there's 3 buckets that we want to focus on. So first is the financial bucket. So that means that the financial resources that you have to deploy toward philanthropy come from different places. It's your portfolio of assets that you're managing that have the possibility to have filters in them to align with your values. Your philanthropic financial investing is important too. It means that we want to look at organizations that we're putting money into in the philanthropic sector with the same rigor that we're looking at investing the regular portfolio. The only difference between a nonprofit and a for-profit company is at the end of the day, we don't get to keep our marbles in the nonprofit sector. But a great quote that I heard was, everyone's on this charge to say nonprofits should be run like businesses. Yes, they should, except that we've got to remember that nonprofits are doing work that no one in the public sector can make money doing. So it's a different way to look at those filters. One of the biggest disservices that I see is people saying, I want to make sure the operating budget is, super low. There's no for-profit company that approaches business that way. And it's so unfair. If I'm running a program where I've got after-school kids that I'm paying teenagers to watch the kids versus I'm running a mental health organization, I have to hire PhDs in the mental health side of the house. So we've got to be careful how we do those filters, but there are things to look at. The 990 is telling. If I look at a 990 and I see that the top 5 earners' salaries in that nonprofit all have the same last name, I'd like to ask some questions. I'd like to know more about what's going on there. So there's things that will show up on the 990s when you're doing your due diligence. So the second, so that's the financial, the philanthropic capital, how do we understand the needs in the community? So in my past life, I did philanthropic consulting and worked with over 200 nonprofits. There are a lot of nonprofits that shouldn't be in business. We've got a lot of overlap. We've got a lot of duplication of work. And so it's important to, as you're making these investments, don't just write a check. Go visit. See what they're doing. There are impact reports that you can look at in the larger organizations. It's all good numbers to make sure that that financial impact is terrific. On the human capital side, this is where you come into play. And what we see in the sector is that your financial check is terrific, but we need your brains. We need your connections. We need you to be telling great stories in the community. And when you're thinking about trying to expand the Jewish impact in the community, what I would say is people tend to think, well, I can't, talk about what I'm doing in philanthropy because it sounds braggy. It sounds like I want credit for it. And I really want to challenge you on that. I want you to tell stories about the work you're doing Number one, validating that the organizations you're investing in are good, valid, strong organizations. And number two, would you please tell them how much joy you get out of doing this work? Because once people see that, the work that you're doing is important, check, but more importantly, this is changing your life, it's strengthening your family, those are okay things to own. It's okay to have a good result for doing this work. Multi-generationally, when you're aligning values with the work that you're doing, there's a lot of ways to check in with your kids, looking at how do we understand the values of your children to make sure that multi-generationally this is going to go on past you, that they're engaged. And there are exercises that you can do to pull out the values of your children. It's a really wonderful, if you have family meetings, exercise to go through some value cards. Ask your kids, what are your top 5 values? Then the second question is, what are the top 5 things you'd want to change in the world if you could? What's the Venn diagram in that space where that intersection happens? And how do we start engaging the kids? Donor advised funds, giving kids the ability to start making philanthropic investments on their own is a terrific way, while you're alive, to see how they're going to deploy assets. If you're having family meetings and making decisions together, it is one of the best ways to prepare heirs for wealth, because you're going to see how your kids interact and make decisions together. Sometimes it's not pretty. It's not a magic bullet, but I will tell you that this is one of the best ways and a tool so that you have tradition and conversation and you have intentional time talking about something that's really important to your family, but more importantly, your kids are going to take on your legacy and your traditions. So it's really the financial, philanthropic, and human capital. The assets that you have as a person to share in the community, please share them. If you have started companies, you sitting on a board can make a huge difference to the organization. I do warn nonprofits that if a financial advisor shows up and wants to be on your board, please don't put them on the audit committee right away, because it might be the last thing they want to do in their off time. But they can't help themselves if they're in the room and the financials are going around the table. So you get both, but let's make sure they're having fun. And there's a terrific paper that was written by my boss, so please read it. I just want to put out a commercial for her. But Aligning Jewish Values with Investing in Philanthropy. And it really hits on, incorporating all of these things into your into the whole part of your financial life cycle. And there's a lot of different ways to deploy assets, looking at all these different categories. And the paper goes into depth on what that looks like. And we've got a link that you'll get after this. You're going to send it out, right? And so any questions about philanthropic engagement in the community? I love that you're in this room investing in philanthropy. This is the way that sharing knowledge really expands philanthropy. And I want to share with you that, when families get together and collaborate on philanthropy, that maximizes philanthropy. So if there's opportunities where large projects are going on, getting everyone in the room understanding the gap in the community, what really needs to happen, and making sure we're putting a strategic plan together, the Community Foundation is the best way to start executing on those things. So any questions at all for me?
I just make an observation based on our experience, and that is, where do you involve your children in the next generation in philanthropy and those decisions? That does place on the Dallas Jewish Community Foundation a certain burden in it's sort of like corralling cats, right? Because the children are young themselves, young adults, doing their own thing. So to get everybody together to make the relevant decisions requires a real effort and work on the part of the foundation to make that happen.
They'll take it on. They're not going to complain about that. It is herding cats, and you have, I think the biggest thing I would say is patience, because every child, well, really every adult has seasons in life, where it's interesting to them, they're more engaged, it matters more to them. So it's more about the cadence of it, creating the traditions that this is what our family does. We have an annual meeting, whatever your cadence is for getting together and doing this work. And a great quote that I heard was, invite them all and work with those who show up. Because you don't want this to cause friction in the family, but what typically happens is when siblings see that, wait, there's something going on I'm missing or I'm not a part of, that can motivate them. But I would say set the cadence, you hold your space, that this is important and what is important in your values. I will say, I was just working with a family where we went to set up a family foundation, and there's 5 adult children, and it was a faith-based family, and when we got to the table, one of the older sons said very articulately, he said, I've got a problem because you're going to write a mission statement that has Jesus Christ in it, and I'm not going to be comfortable with that. And I respect your values, I think it's great, but I don't want to jeopardize the relationship with my siblings. It's a tough moment. You're sitting at a table thinking you're setting up a foundation with shared values, right? What we did was we set up 5 separate donor-advised funds and a mothership for the family. And so what's going to happen is that the family's going to give them space to invest in things they care about, but there is a collective fund, and the parents said, of these issues that we're investing in, is there something that you could align with us? And each family member said yes. And so the parents are going to work with them on one individual project to keep the continuity of the family, but they're giving them the space to be able to take the judgment out of the room, I guess is a good way to put it. So sometimes it's uncomfortable. It's hard when your kids...
Yeah, most of the things so much of that is always just the logistics of getting, like you said, a family, 5 kids, and they're all doing their thing and whatnot. I'm saying just the logistics in the foundation, getting the relevant reviews and the logistics of meetings and deadlines and that kind of thing, where you involve children of the next generation. That's...
I would look at how do you add fun. I would say, how do you add fun? So that means, can the major decision be in a fun location, engaging the whole family? So in my family, we have a meeting once a year with my whole family. But we pick the place, and that's the way we keep the continuity in our family. So the kids don't want to miss out on a fun vacation. So the reality is they're all busy, and it doesn't hurt to entice them with some fun. I know I'm over time. And I'm going to be here if you have any other questions later.
It's so great to see everyone again today. So I'm Robert Morris. I'm one of the directors of Morgan Stanley, joined by Paul Cox, my colleague and co-director. And thank goodness we're all in here today instead of actually tuned into CNBC, as Steve said, just because of all of the massive amounts of news and volatility we've seen recently. What we're going to spend our time together on today, we've got about 10 to 15 minutes just to kind of quickly go over what we see taking place maybe for the balance of this year. We want to touch on some of the fund structure items that Steve mentioned earlier at the latter part of the presentation, and I think we're allowing for some good Q&A at the end of this as well. So at a quick glance, by the way, just past this prologue, so we need to know a little bit about what has taken place to unwind what we're seeing now in the market activity. The first thing that we'd just kind of call out, last year, of course, was driven incredibly strong returns, but it was primarily coming from just one concentrated piece of the market. You look at the tech sector at a 36.6 rate of return in 2024, compared to the average since 1990 of 18.4. That pulled large caps higher as well. Small caps had an ordinary year, which, by the way, you're supposed to, in classic theory, earn more from small caps than you are large caps. And the rest of the world slightly punched below its weight. So we had a good year, but on the back of a lot of the technology. That was driven primarily not by earnings, which fundamentally we really do have to take a look at what companies are earning. That's why we're investing in common stocks, is to try to get that earnings growth. We get a little bit of boost, typically from dividends, and then valuations over time have increased, but at a more modest pace. So since 1990 is kind of the normal. What we've experienced in the past 2 years, 2 exceptionally strong back-to-back years, about a 19.8% of that total return was driven by valuations increasing. That means more money chasing those stocks. And in particular, it's the Mag 7 that have really done that to us. A lot of enthusiasm, obviously, in the area of technology, AI growth, which we can certainly talk about later on. But the rest of the market actually exhibited a normal 10% year. And that's one of the good messages here that we have today, that we actually do believe that the earnings for the other 493 companies are really starting to play out, whereas obviously we've seen some recent challenge in the AKA Magnificent Seven. As we look here, we're not calling necessarily for that Mag 7 to completely stop earning. In fact, they're great, powerful companies. NVIDIA's still going to sell chips. Microsoft's still going to sell cloud space and software. But the growth rate of that net income is actually going to slow down or kind of normalize with what we see from the rest of the market. So the good news about today and the recent market action over last week is we're actually self-correcting some of what was the imbalance on last year. When you had price to earnings level of Tesla at 126 forward earnings. Said another way, that basically means investing $10 into Tesla would basically take 126 years worth of forward, just holding it static to basically get back to where you would have been. So it's normal to see this kind of drawdown in those peak Mag 7 companies versus the rest of the market that has been relatively flat. Now that obviously informs how we structure some of the underlying portfolios, in particular where we have the equity allocations and so forth, trying not to take too much risk on with the Magnificent Seven and looking at other areas for growth. Small and mid caps, for example, rest of world companies, for example. So let's talk a little bit about inflation, because ultimately here's one of the critical things that has changed and will obviously impact what we see for the balance of this year. So I'll kind of tell a little sort of joke here. I think the audience is of the right era to recognize Monty Python, the greatest export of the UK. So if you remember the Black Knight that obviously they were trying to slay that got in the way, that's basically what the Fed has been doing with inflation. Cut off one of the arms, but now inflation's still back saying, I'm not dead yet, and they've got to turn around and still fight inflation. So this is so handy, by the way. I love doing these presentations when there's like new news and it updates one of the figures. 2.8 was the inflation reading in December. Guess what? Today it came out 2.8. So we're still in date with this slide. But that is heavier than the overall target. The Fed ideally would like it to be at 2%. That's one of the critical reasons right at the end of last year where the market anticipated 4 rate cuts, and that was really impacting the bond market performance. The reason why that's not likely to materialize is because inflation is still stubbornly heavy. Near term, by the way, tariffs will have an impact on inflation. It takes a while to see those type of actions actually play through the economy. And because of that, we see a bond market that is likely, we're not going to get as many rate cuts, will probably stay level for the balance of this year, which is not a bad thing for the fixed income investments we have, because we actually earn a pretty decent coupon off of those. So that again provides some stability into the funds. Key drivers of inflation, I do just want to touch on this area here, wages. Obviously, this is an area that the Fed is looking at. You are starting to see now signs of companies just doing I hate to say this, but they almost term it the natural layoffs, just where at the beginning of a year, they'll just let go a bunch of people, usually 2,000 here, 5,000 there, kind of right-size some of the organization. You're seeing that come out now in earnings announcements, and you're also seeing what's happening in the government sector too, where there are clearly going to be some job losses, some today at the Department of Education, for example. That we still have positive wage growth. We're kind of, unfortunately, at the beginning of this year, the main term has all been about what they call a growth scare. Will the growth that we had experienced last year be able to continue? We are on a knife edge, but most of the figures are looking still positive. There is one other knife edge to talk about, and that's the consumer. So Target and Walmart made my job here today a lot easier because in their earnings announcements, they actually discussed one of the things that we have been chatting to the investment committee about for a good amount of time, and that is, unfortunately, the rising level of consumer debt, $1.2 trillion. Savings rates, very low. So if there were a shock to the economy, we still need some of those stabilizers or shock absorbers to basically help smooth out the ride there. The consumer is still spending, but begrudgingly so, is kind of the main message. This augurs for no increase per se in earnings growth rates for this year. In fact, our firm anticipates that what was forecast in 2024, which is about a 13% earnings growth level, there won't be any surprise above that. In fact, we'll probably come in right at that overall 13, maybe a touch lower. We also don't believe we're going to see any valuation increases. Remember those charts of showing price to earnings expanding? That was last year's story. We think this year basically stays pat, which would, from this point on, at least be a fairly decent return for the market. High single digits, actually, is what we would see maybe from now to the balance of the year. But it's certainly going to be choppy with all of the vast amount of news that we're seeing coming out of the administration. It's really a lot of sea change events, and that takes time to monetize through the system. So in general, in this backdrop, a couple of the things that we like: investment-grade bonds, not too shabby to be able to earn a 5.5% coupon without some of the drama. Equities should still be strong. And then also the inflation risks, though, because of the tariffs and other policies, which, by the way, we could certainly talk your ear off about that. We do think on the Chinese side, there's a lot of political motivation, and that's where we have the greatest trade deficit. But believe it or not, China is not our largest trading partner. They're actually only 10% of the mix. Mexico and Canada are actually bigger trading partners. We just don't run as great a deficit against those. So given that, things like infrastructure, for example, some of the still inflation-sensitive investments that we have within the portfolio should bode pretty well for the balance of this year. And with that, I'm actually going to turn it over to Paul to talk about some of the model changes.
Excellent, thank you. Your investment committee has worked very closely with our team to streamline the investment pools. And the reason that they have taken that decision is to make it easier for you as unit holders and as investors in DJCF to understand what you're investing in and why. And so really quickly at the top, you can see we have active strategies that are based on the risk tolerances, or another way to think about it, the timeline before those funds will be dispersed. And so underneath in the middle portion, you can see what those pools are made up of. So if we look at the balanced pool, for example, you can see that 35% of it is coming from the fixed income, color-coded down there, and you can see what makes up the fixed income pool. And 65% is coming from the equity or stock fund, and you can see that the stock fund has, it's harder to see on that screen, but it's both US domestic and international stock. Really quickly for the group, if you see down here, the slide is getting a little bit busy, but underneath, this shows you the ranges that have been built into the investment policy statement. Why does that matter? It matters because these funds need to last in perpetuity. And so the investment committee has set up a policy statement that gives us the guidelines, the barriers of how much we can invest in different parts of the market. And so you can see the sub pools, how that works for each of the different asset classes. And then just really quickly, we've also introduced in conjunction with your investment committee, a passive pool. So for those of you who eschew passive investing, you have that option as well. And one last quick thing before I turn it back over to Megan. For those of you who don't know your investment committee, they are made up of practitioners who've been in the business a long time. They are very diligent in focusing on the pros and cons of different investments. We have a lot of very lively debates, and you should feel confident that they take their responsibilities very seriously, and they're very focused on making sure that these funds are around and available for the community as needed. With that, I'll turn it over to Megan.
Thank you all again for being here. I wanted to also just say a note of thanks to our team at Greystone and at Morgan Stanley. They're hosting us in their building today. They've provided our bagels and our refreshments. They also agreed to pay for valet and offer, free investment advice for anyone who's interested in learning more. So thank you again. We've really appreciated and enjoyed working with your team. And I don't know about anyone else in the room, but whenever I hear Robert's accent, regardless of the chaos that's outside, I feel so calm. I'm almost ready to fire my therapist, who's been calling more regularly than my broker year to date, so that's saying something. Again, thank you all for being here. We're about to start something that I'm really passionate and excited about, which is talking about mission-aligned investing and how we express our support for the State of Israel and the Jewish people through the investments that we offer here at the foundation. And for those of you who have been clients and working with us for a long time, this might be a surprise, but this is actually not something new. We have been among the earliest investors in pro-Israel and pro-Jewish investment vehicles since they've begun to be introduced. So I'd love to welcome my friends on the panel. If you have a microphone, please join me up here. And I'm glad none of you are in a skirt. But thank you all for joining me today. We have representatives from 3 different managers who you are invested in as fund holders of the foundation. And joining me are Israel Bonds from our fixed income or bond asset allocation strategy. Gary from Israel Bonds is here with us today. I have my friend Jake from J-Lens. He's named very appropriately. They told me that was not part of your hiring decision, that you could be J for J-Lens, Jake. And we have my friend Daniel Frankenstein in from New York, who is with Jewel Ventures. And Jewel Ventures is in our endowment portfolio, which is part of our alternative assets exposure. So I'd love to start our panel discussion just by asking each of you to introduce yourself and just kind of a quick overview of what you do and how you are accessing the market today in your respective businesses. So Gary, you're next.
Okay. Well, thank you. I'm happy to be here this morning. I'm filling in for Larry Berman, who's our Vice President of Institutional Sales. He is very sick in New York right now, but he and I spoke yesterday, and so I'm glad to be able to fill in for him. I've been working for Israel Bonds now for almost 14 years. I have a bachelor's of business administration from Washington University and a master's of business management from UTD here in Dallas. And if you would have asked me when I graduated, either undergraduate or graduate school, what would be the 2 areas of business that I would absolutely never work in, the first would have been accounting, the second would have been finance. And so the fact that I'm working almost exclusively in finance now is just a miracle to me. But miracles come along with working in the Jewish community. So I'm very happy to do what I do. My family is very involved in the Jewish community. And as I said, I've been doing this for a long time. Israel Bonds has been around for a long time. They've been around since 1951 when Ben-Gurion, the first prime minister of Israel, first introduced Israel Bonds. And since then, we have sold $54 billion worth of bonds since 1951. And I'll talk a little bit more about that later, but I just want you to get to know me.
Jake?
Hi everyone, I'm Jake Herman. I am Director of Communications and Development at JLens. I'm not the only Brit in the room for once, which is nice. Thank you, Megan, for hosting us today. This is my first time in Dallas and my first time in Texas. I live in Boston, Massachusetts now, and flew in last night. So JLens, our business is shareholder advocacy. So the Dallas Jewish Community Foundation has been a partner of ours for about 4 or 5 years. JLens has been around since 2012. And right now is a very exciting time for us because 2 weeks ago we launched a new product, the first ever Jewish advocacy ETF on the New York Stock Exchange. We already have over $100 million in assets in that brand new vehicle within the last 2 weeks. We have about $300 million in our previous strategy, which is a separately managed account strategy. And that strategy it's an own and advocate strategy. So we're looking to have similar risk and return to the S&P 500. We have many of the largest US public companies that we're invested in. And the reason that we're holding those companies is so we can do advocacy on behalf of shareholders in the Jewish community, on behalf of you kind folks in Dallas at the Jewish Community Foundation, and push those companies to do better on combating anti-Semitism, on supporting Israel, and on various tikkun olam, repairing the world issues. I've been with JLens for about 3 years now. JLens has been an affiliate of the ADL, the Anti-Defamation League, for the past 2 years. And as I said, it's a really exciting time for us, and I can't wait to answer some of your questions.
Good morning, everybody. Daniel Frankenstein, Jewel Ventures. Just like the monster, it's okay to laugh. It's a fun icebreaker. Thank you so much, Megan, for arranging this. Thank you all for having us. I'm a co-founder and partner at Jewel Ventures. We are a US-based venture capital firm, but we exclusively back entrepreneurs coming out of the Israeli ecosystem. This is a really interesting journey for me personally because I'm in this business by accident. I started my career in the consulting space, worked for a New York Stock Exchange traded best practice research firm out of Washington, D.C. As the financial crisis was taking hold, they were looking for revenue outside of the United States, specifically looking for places that had large numbers of publicly traded businesses in the United States. Israel happens to have the 3rd largest number of publicly traded businesses on US exchanges for any foreign country aside from Canada and China. So at 27 years old, I was sent to Israel to be the country manager of this US-based business. Built their business in Israel for a couple of years, but saw this unbelievable technology ecosystem. But there were 2 challenges. One, folks like yourselves couldn't access that ecosystem from the investment side. And 2, the entrepreneurs in that ecosystem had a tough time going to market here in the United States. So we launched our firm 15 years ago to be a bridge. How do we help more Israeli entrepreneurs go to market more effectively in the United States? And how do we provide a sophisticated premium portfolio investment opportunity for sophisticated US investors to back those entrepreneurs? Fast forward to today, we're an institutional early stage investor, still exclusively focused on the Israeli ecosystem, and absolutely delighted to be here, talk about everything technology, everything Israel, everything related to how we produce returns. And just one plug as well. We exclusively back entrepreneurs in the Israeli ecosystem because fundamentally they're better. We do not believe you have to make a trade-off between your mission and returns. And we're a top decile net cash returner in the asset class. And I don't say that to toot my own horn. I say that to toot the horn of our portfolio companies that have generated those returns. So my mission is also to make sure that people know they don't have to make that trade-off. Just do the same amount of diligence that you would do on any for-profit type of investment.
Thank you. And I didn't actually plan that tee up, but that was a perfect lead-in to my first question. So for those of you who don't know, I'm a recovering private banker. I spent 15 years in finance. I also was a little bit of an accidental finance person. I was a marketing and psychology major at Indiana University and was offered a job at JP Morgan when I graduated in 2008. And I really fell in love with the idea that you could do well and do good at the same time, whether we're talking about your personal assets or the assets of institutions or clients that you're managing money on behalf of. And as also a relative newcomer to Judaism and the Jewish community, it was really interesting to me, the psychology of an investor in the Jewish community about Israel. Because for a long time, the generation, like my in-laws who grew up with Israel always being the charity case, for lack of a better term. You've got to support Israel. We need to do it. It doesn't really matter what the returns are. It's just the right thing to do. And I think we've really evolved as a society, and I think Israel has really evolved as a country, and that is worthy of investment, and that it's exciting and interesting and compelling to invest in Israel, and it feels good, which is kind of a nice change of pace, but I think the average investor is a little bit, hasn't quite caught up necessarily to that mentality. How would each of you, and Daniel, you already sort of addressed that, so for Jake and Gary, how are you talking to your prospective investors or your longstanding investors about the changing dynamic of potential in being pro-Jewish when you're investing in the US stock market, or being pro-Israel in looking at your fixed income allocation?
You want to start?
Sure. So I think Jalen's is the outlier here because our strategy is only in domestic equities. But a big part of what we do is look at how those companies are operating in Israel. And we're encouraging companies, S&P 500 companies, to have economic ties to Israel and to push back against our opponents in this arena, which are the BDS movement, the boycott, divestment, and sanctions movement, who are doing the direct opposite, trying to push companies to pull their business from Israel. So Jalen's is fundamentally a research and advocacy nonprofit organization. We're an RIA as well. And in our research, we found that approximately 220 out of the 500 largest US public companies have operations or customer relationships in Israel. So that can be ranging from having offices and staff directly in Israel to having R&D centers or partnerships with R&D centers in Israel, having acquired Israeli companies, or just having a customer base in Israel. And over the last year, we've counted that 75 of those companies have been targeted for boycott or divestment from Israel. And so our role in the space has been pushing back against that. A few of the ways that we do that, so we're in direct dialogue with those companies. We're here to represent the shareholders, and that gives us a seat at the table. It gives us a voice in that arena. So we're in direct dialogue with company management and with investor relations, with HR, depending on the topic. And one of the other major ways that we do that is through the proxy voting and shareholder advocacy process. So every year we're seeing proposals that are put forward by BDS proponents on the proxy ballot at major companies. So some examples from last proxy season, and we've seen some coming up for this year. Proxy season is approximately from April to June, when most companies have their annual general meetings. And last year we saw two major proposals. One was at Amazon, which was a proposal essentially asking the company to reevaluate its cloud computing contract with the Israeli government. So Amazon and Google have a joint $1.2 billion cloud computing contract with the Israeli government. And this proposal was asking them to revisit that relationship. And what we did was go to all of the major shareholders in Amazon, BlackRock, Vanguard, Morgan Stanley, and others, and speak to them about the issue and ask them to make a common sense voting decision and vote against this proposal that we saw as discriminatory against Israel. And so in 2023, it got 34%. Last year, we managed to get the vote down to 17%. And that was one example of that kind of advocacy. We've also seen, sorry,
and
yes.
also in the last year, the performance. Can you talk a little bit about the outperformance of the SMA over the broader market?
Yeah, so we're doing this advocacy. The background to this advocacy, we don't see a trade-off at all. Sorry to have got off topic from the question, but we don't see a trade-off at all because our strategy is designed to have similar risk and return profile to the S&P 500. As Megan alluded to, I believe it slightly outperformed the S&P 500 in the last year, but that's by coincidence. Our goal is to track very, very closely. And we believe you can have, as Megan said, you can do well and you can do good. You can do well, track the S&P 500, and you can have your voice, this strong Jewish advocacy voice in the arena in order to support Israel.
I think it's really exciting too because JLens, with the introduction of a retail product, is now extending, and we're really sort of catching up to our peers in the Christian community. There's a number of Christian value ETFs that the average person with just a regular size investment account like myself can now access and express my values through my own investment portfolio, which I think is a really exciting new chapter. So thank you for sharing that.
Great.
And Gary.
So it's real simple with Israel bonds. I mean, in 1951, when they first introduced Israel bonds and they started selling them, the goal of Israel bonds was to provide capital for the state of Israel to build everything that they needed: roads, hospitals, airports, seaports, because it was a brand new country and they needed money to do all those things. Fast forward to just before COVID, Israel was within the top 10 economies in the world. So in terms of investing in the state of Israel, you're investing in a winner already when you invest in an Israel bond. Our bonds range in the rates on our bonds, the coupons on our bonds range from 4.17 to 5.71%, depending on how much you're investing and for what period of time. And we try to keep our interest rates just above. It's always going to be U.S. Treasuries plus a certain number of basis points, plus a spread. So we try to stay a little bit ahead of U.S. Treasuries in terms of the rates that we offer. And listen, with BDS and everything else that's been going on, the anti-Semitism and so forth, I mean, we've grown tremendously. I mean, since October 7th, we've sold $4.5 billion worth of bonds. And in that period of time, we've signed up 8,000 to 10,000 new investors that had never invested in an Israel bond before. So when they talk about the resilience of the Israeli people and how it's going to take some time for them to spring back after what happened on October 7th, they're very resilient and they're already springing back, and the economy is already springing back. And so we're not concerned at all about the value of our bonds, and we appreciate the commitment of the Dallas Jewish Community Foundation. They just bought another $400,000. I'm sorry, another $400,000 worth of Israel bonds this week, and they hold over $4 million worth of Israel bonds. So they're committed. You're committed to Israel bonds, and the numbers just keep growing. So I don't look at it as a risk at all. In fact, I look at it as a very good investment.
Thank you. So I know we're all, we have 10 minutes left. Okay. So I know we're all looking for something to talk about at cocktail parties, given the slow news cycle and that there's not a whole lot going on in the world. And so I'd love for Daniel to talk a little bit about some of the highlights of what we're investing in through our commitment to Jewel Ventures. And before I hand it over to Daniel, I just want to remind everyone that these managers are part and parcel with our investment strategy. That is actually quite an unusual approach. Most of my peers have a separate pool of money that this is the impact investment. This is your mission-aligned pool. we sort of flipped that mentality on its head. We said, we are the Jewish Community Foundation. It should be infused in everything that we do, aligning ourselves with the values of our people, of our culture, and of our tradition. And so I just wanted to highlight that because it is a bit of an unorthodox approach to investment management in the sector. So give us some cool cocktail party conversation starters.
Absolutely, because I know there's, as you said, there's nothing to talk about. First, maybe let me give you a sense for our strategy, why we do what we do, where we do it, and then some examples. So first of all, how many of you have been to Israel? Okay, most of you all, but maybe let me just very high level. In Israel, everyone has compulsory military service. 3 years for men, 2 years for women. But however, most of the people that serve in the Israeli military don't actually touch a conventional weapon after basic training. Many go into technology, research and development units in the Army that have very specialized skill sets in the advanced intelligence gathering, cybersecurity, offensive cyber, artificial intelligence, mobile technologies, and they learn very interesting skill sets that are not commercially available. How many of you have heard of the 8200 intelligence unit? Okay, interesting. So this is great. So the largest unit in the Israeli military is called the 8200 intelligence unit. It skims the top 1% off of all Israeli high school students. They start doing aptitude tests around 14, 15 years old. And they're testing for one thing. How quickly do you learn? That's it. They take the top 1% of quick learners and they put them in this unit where they do their military service behind a computer. They are learning advanced engineering and technical skills. They're learning advanced security, cyber warfare. And these are the entrepreneurs of the future. They learn skill sets that are not commercially available. You cannot learn these skill sets in the classroom. You cannot learn some of these military grade types of coding skills in the classroom. So they spend time in the 8200 unit. And by the way, there's a number of offshoots and specialties. There's 8-1, there's Talpiot, there's Mamram. There's so many different places where these young folks learn tons and tons of skill sets that, again, you cannot learn in school. But then they do go to school. And they go to school at some of the most elite universities in the world. The Economist magazine out of the UK does a global 1,000 index of institution of higher learning. There's only one place in the world that over half their institutions of higher learning, that a country has over half their institutions of higher learning on this global 1,000 index, and that's Israel. Most of these institutions are public institutions. Said another way, kids don't graduate with debt, which means they can be entrepreneurs. They don't have to fulfill that obligation. So you take this unbelievable group of entrepreneurs, this unbelievable education system, this unbelievable training in the military, and you have the entrepreneur built for the future. You have a resilient entrepreneur who has real world and life skills, who has worked on teams, has trusted folks that they work with, and non-commercially available skill sets that my firm has the opportunity to back. So we saw this starting about 15 years ago, but it's really hard for the American investor to look at these deals and understand exactly what you're looking at, how to validate these deals, how to validate these markets. That's what we do at Jewel Ventures. I'm going to give you all two examples of companies that we backed historically because we actually know how they panned out. And then I'll give you one example of a new deal we're in the process of doing in your fund. And I'll do it really quickly. Really quick. First, I met with an entrepreneur back in 2011 at a coffee shop in Tel Aviv. He was my neighbor in Tel Aviv. And he was in the 8200 intelligence unit, but a little offshoot. And what they basically did is they took this entire unit of the top 1% of high school students, and then they took the 1% of that 1%. And they said, you know what? You're not doing your Army service yet. Half of you are going to go to school and get a PhD in physics, and the other half of you are going to go to school and get a PhD in math. Then you're going to come back to us, and you're going to do research and development for the future of warfare and the future of intelligence gathering. So I'm sitting with this guy who was the top of that group, who got sent back to school for physics, came back and did his Army service. And he built a system in the military called behavioral biometrics. That is, layman's terms, is how you move as an indicator of who you are. So as you might imagine, there might be an application for a technology that could tell you who is behind a computer terminal at a certain particular time. And that was the technology that this individual developed in the Army. He rolled out of the Army and he said, I want to introduce behavioral security for US financial institutions. So I said, you're going to have to, speak English, because I don't know what that means. He said, listen, the way you move your finger on a mouse trackpad, how hard you press, how fast you move, do you click on the top right of something, the bottom left of something? These are all things that are unique to you. You don't know where your mouse is, you do one of these, you do one of those, you do it the same way every time. These are unique identifiers of who you are, as a great way to understand if the person who logged in to an online banking session is actually the same person who made the bank transfer. So huge opportunity to detect fraud. So we took this to a few banks in the United States who literally kicked us out of the room. They said, this is Star Wars, it can't be done, you gotta go. So came back to the entrepreneur, said, hey, listen, we got some pretty bad feedback. Like, no one thinks it can be done. He said, they're wrong. I said, these are some heavy hitters in the financial services industry. They're not usually wrong. He said, here's the deal. I built the system already, and it works. And thank goodness for me, the IDF doesn't sell to banks. So we wrote him a check, went on a 10-year journey with this company, sold them early last year in the middle of this war for $1.3 billion to a UK-based private equity firm. See, UK, look at that. Great outcome. I'm going to skip the second example because I went too long. I want to tell you about a really interesting company that is in your fund right now. We're executing that deal as we speak. And interestingly enough, in small world, Texas Capital Bank is looking at potentially being a customer of them. This is in the artificial intelligence space for personal financial decision making. Most folks in our country do not have access to wealth management. And they just have a checking account, they have credit card, they have debt, and they are not optimized for their personal financial decision making. They don't have a family CFO. Guess how much time people spend on their personal finances every month, average? Most people? Yeah, less than a minute. That's a golden minute for a financial institution. Imagine if you had a autonomous, artificial intelligence-based family CFO where your bank offered you the opportunity to autonomously move money between checking, savings, credit card, tuition payments, completely optimizing your financial decision-making, which, by the way, not being optimal in that regard costs the average American consumer $5,000 to $7,000 a year. That is big money for people making the average per capita income here in this country. Huge opportunity. This entrepreneur rolled out of the 8200 intelligence unit, is a Harvard PhD. He wrote his PhD thesis on personal financial decision making. Really incredible domain expert. So just to zoom out, you have exposure now to the future of cybersecurity, the future of artificial intelligence, the future of business infrastructure from a technology standpoint. That is what we do, and we do so actively. We are not writing checks to our portfolio companies hoping that they show up in a few years having increased their value. We're actually their partner. We're their partner in going to market. We're their partner in helping to get customers. And absolutely delighted to be partners with all of you because, and I'll close with this, the Jewish community is criminally underinvested in Israel. The Jewish community has let the rest of the world generate billions and billions and billions of dollars in return, because our community only sees Israel as a place exclusively for philanthropy. It can be both. It can be an and, it doesn't have to be an or. And you guys are pioneers in looking to generate great and top asset returns out of a place that's mission aligned. And I think that's phenomenal and gives great credit to Megan.
Because we are the first Jewish community foundation to invest in your fund. Is that right?
That is right. We actually, a majority of our capital does not come from, we don't talk to Jewish money. It's been...
Until today, we have some Jewish money in this room.
That's fine.
Hopefully.
That's fine. Just as a point, our biggest investor is the Sovereign Wealth Fund of a Native American tribe. We have multiple funds of multi-billion-dollar registered investment advisors. We work with a bunch of big family offices. They don't care where we do what we do. They don't care how we do it. They just care that green is green, that it generates returns. Obviously, and of course, we have members of the Jewish community that are invested with us. We have private individuals, Jewish family offices, and now you guys, and delighted to grow that.
Okay, I'd like to welcome my partner Steve and Robert and Paul disappeared. Oh, there he is, Paul, to come on up and let's transition to Q&A. I received a few inquiries for Q&A in advance, and so I'm going to start with the first question, which I thought was a really great one, which is, if you had one call to action for people in this room today, what would be your call to action? And I'm going to start with Steve.
Call to action. I thought I was leading the Q&A, not answering questions. Call to action, even in regards to a portfolio?
In regards to anything, like what if you were just an average person and not the head of our investment committee, what would you do differently with the firm?
So I'm sub-average. Is that what you just said?
Whatever you want. You can
So here's the thing. The number one call to action that we see over and over again, and I see in my family and I see at work, is people choose to let the state be their decision maker when they go horizontal. So folks don't have a will and they let the state distribute their assets. And that's just almost criminal. You're almost inviting your family to argue over that tea set or whatever. Please, you can make a will that's serviceable in the state of Texas online in 20 minutes, and it's just not that complicated. And there's plenty of lawyers out there. I know a few that more than happy to draft one for you, and just doing that for your family is like the number one thing in that single minute that Dan's talking about. If you could just take 20 minutes and do it. And my kid's 28. Full disclosure, my kid works for Annapurna Labs, Amazon. So so we're against all that BDS stuff because Shasha Trofanov just got released. He's on my kid's team. Anyway. I can't get my 28-year-old to do it, and he's in Taiwan right now with an Annapurna vendor. It's just talking about keeping your dad up at night. That's what it does to me, because I want him to have a will. It's just not that hard. So.
Does anyone else have a call to action that they would like to? Not everybody has to answer that.
I would just say, actually, you've kind of seen the horsepower that's placed into the room here. Talk to Jerry, talk to Megan. You've got an incredible resource here in the community for philanthropy. Hopefully use that optimization software to then free up that $5,700 that can also then be reinvested into the community.
Really quickly, kind of tying in Marty Dutch, what she was talking about at the beginning, bring your children, if you have children, bring them into your giving. Talk to them about why you're supporting DJCF. Talk to them about what it means to you. And the earlier you can bring them in, the better the outcome's going to be in terms of helping them learn and understand and to gain the same joy you feel in supporting the community.
So, okay, we'll open it up to the room for Q&A, and the moderator, Steve, is going to repeat the questions when they come in for benefit of our friends on the recording. So, any questions from the room?
Steve, I thought I heard you say at the beginning that the difference between personal capital and philanthropic capital is we have to part with the philanthropic capital. If it's a donor advised fund, ultimately it's going to be gone. Did I hear that right?
So the question was the difference between personal capital and philanthropic capital is that the philanthropic capital is going to be gone. And so let me clarify that a little bit. When you have from our perspective on our side of the balance sheet, when a donor makes a gift into a donor advised fund, we don't know when the donor is going to decide to make a gift. And so for us, that money could be invested for weeks, years, and this comes back to my will comment. If the money's not going anywhere sometime soon, please get a gifting committee of your kids or your family members in case you're jumping off cliffs or hang gliding or something that we think you shouldn't be doing, and you go horizontal before you make those gifts.
Thank you, because that clarifies, because I heard Paul say later that the job was to keep the money there forever. So part of it's going to be distributed and part of it's going to be endowed.
Could be, yeah. And an endowment, again, the sun swallows the planets. That's 4 to 5 billion years from now.
Yeah, and to clarify that point, we want DJCF to be around forever. We want the assets of DJCF to be around forever and to grow so that pool doesn't totally diminish. So,
Job security for another year. Any other questions from the room?
Oh, we know they're there.
Yes.
With apologies, I'm not a financial or economics type person with any knowledge at all. The way that I think a lot of the discussions go is that there are like two silos. One silo is the Dallas Jewish Community Foundation, philanthropic, and you've talked about how you manage investments, if it's a DAF, different than an endowment, all of that kind of information. The second silo is the non-philanthropic assets that a person has, something that's outside of, let's say, Dallas Jewish Community Foundation or any philanthropic activity, and there's ways that each of us have developed for handling that, whether it's going to Morgan or just winging it on your own or whatever. But I don't see other than advice that you might get from a financial advisor or just out of your own head, I don't see those two silos interacting, or something on the philanthropic side, Dallas Jewish Community Foundation side, that says, okay, well, if you have the question, it's up to the person's initiative. Here's how you could think about staging and organizing and tax considerations, whatever goes into this that I don't understand, so that you can have a flow to the silo that is the philanthropic silo, that is smooth, that is tax efficient, that has the right investment tenor, that kind of thing. So I'm just saying I see these two silos right now as having limited interaction and mostly from the side that's outside of philanthropy. And I'm suggesting that maybe the philanthropic silo could build its ability to share information and to comment to a person about staging and the logistics of transferring and when and where and how, and, from the non-philanthropic silo into the philanthropic silo.
So
Did I say that so that it sounds like?
yeah, so I think Bernard's question and comment is that we all have personal assets, we've been blessed in that way, and there's philanthropic assets, and that the two can be integrated, and the two should be covered completely by estate planning and financial planning. And how do we educate? How do we inform? How do we make sure that when you're thinking about leaving a legacy, making gifts, that it's completely integrated with everything that you do? And I think we've done an excellent job over the years of working with the estate planning community on how we make sure estate planning attorneys and CPAs, et cetera, are up on things. But yeah, there's probably more to do. And I don't know if Megan's starting that podcast anytime soon, but for sure, more on the website now. So that's why I want to take that.
Well, if King Charles can start a podcast, I feel like maybe there's a chance for me. I would also just expand upon that, and Steve, great start. So later this fall, September 19th, we will be hosting our 30th annual Professional Advisors Seminar, which was a pioneering concept 3 decades ago, led by my predecessors here at the foundation, to really do much more proactive outreach to our partners in the professional advisor community. And so since that time, we've hosted 30 of these seminars. We welcome 300 professional advisors from across North Texas to that breakfast meeting. And then we've also expanded that to include quarterly roundtables where we bring in a local expert or a national person to share on a certain subject that's of timely relevance. But there's a lot more to do, and there are a number of leading educational institutions that are focused on this. One is the Chartered Advisor in Philanthropy program. 2 of our staff members have that designation, myself and Risa Gross, who's right behind you, which is a formal master's level education in how to bring that ecosystem together, the nonprofit organizations, the professional advisors, and the philanthropists themselves. And so there's the Lilly School of Philanthropy, but I think some of what you're getting at is that philanthropy, in the terms that we think of it today, donor-advised funds being the primary vehicle, sort of a new entry to the scene. They didn't really start taking prominence until the last 15 years or so, where it became a truly democratic environment where you can start a fund with us with $5,000. That access didn't exist. And now, of course, you've got Fidelity and Schwab and Vanguard and Daffy and all of these tech-enabled organizations. But we are focusing more on that, and that's great feedback. So our topic this year, for the second year in a row for the seminar, is charitable planning focus. So we're inviting Paul Casperson, who is a leading provider and attorney in the space of accepting non-cash assets to nonprofit organizations. So he's going to be speaking on that. And then he and I are going to have a conversation about AI and how artificial intelligence can be disruptive and complementary to the human capital that Marty was talking about in the nonprofit sector. So we're talking about what role can artificial intelligence play in thoughtful charitable planning. And so I'm very excited to welcome you to that as well.
Can I just briefly, I just want to address that as well. Keeping in mind that Israel bonds are not a donation, they're an investment, but we have a new product called the Shalom Bond that is a 1-year maturity that you can actually buy an Israel bond, support the state of Israel in a philanthropic way because the money goes directly to the treasury, and at the same time donate that bond to a nonprofit here so that when it matures, they will get the principal of the bond in addition to the interest that it earns. So anytime you buy a bond, you're supporting the state of Israel. And right now with BDS and the growth of anti-Semitism, one of the best ways that you can fight those things, and we, by the way, and we don't feel it as much here in Texas as they feel it in other parts of the country, but it's existing and it's growing. But one of the best ways to fight that is through the investment in an Israel bond. And it crosses over because if you invest in an Israel bond and you donate that to a nonprofit, you're supporting Israel, and at the same time, you're supporting that nonprofit once the bond matures. And then in the meantime, holding Israel bonds in your own portfolio, in your income portfolio, non-philanthropic, also supports the state of Israel in a large way. So Israel bonds does exactly what you're talking about. Sure.
Excellent.
Any other
What else we have?
burning questions from the room? Well, that's good. You're going to make your time up.
Terrific. Well, thank you all for coming.
Thank you. Thank you to each of you for being here today. We are excited to pilot conversations like these with each of you today. If you have feedback, if you have questions that you want to share, each of us are around and available, and welcome the continuation of our conversation. Thank you all for being here. We really appreciate it and look forward to continuing the conversation soon. Thank you, Tammy.
Thank you.